Thank you, Nikunj, and let me welcome everyone to this earnings call, which is being, held on this very new format. And I would like to basically start by this earnings call by saying that the second wave of the pandemic has turned out to be far more devastating than we thought. And we have all, as in the pharmaceutical industry, faced mounting on-site infections coupled with lockdowns, which all have posed significant challenges to our operations across our facilities in Bangalore and Hyderabad, particularly at our API plants. As you know, we are a fermentation-based industry, and many of these supply chain challenges included things like oxygen shortage, etc. So we have been impacted this quarter, but we have taken several measures to mitigate the impact of the spread within our organization. A massive vaccination drive was also undertaken for our employees, their families, and our neighboring communities, wherein more than 20,000 doses of vaccines were administered. We simultaneously ramped up the manufacturing of itolizumab, which has been at the front of our fight against COVID-19. And I would like to share with you that more than 27,000 patients have benefited from itolizumab thus far. We have received several testimonials of appreciation from patients, family members, and healthcare professionals for the number of lives that itolizumab saved throughout this pandemic. With the vaccination drive picking up pace and newer vaccines on course to get to government approval in India, we are hopeful that the situation will turn for the better sooner than later. While there are signs of recovery, we cannot drop our guard. We must stay vigilant, ensure that we get vaccinated, and stay safe. I would like to also share with you an important management update. John Shaw, the Vice Chairman and Non-Executive Director of Biocon, will retire from the Board of Directors due to health reasons on 23rd July, that is today, at the conclusion of the annual general meeting. As a key member of the company's board and the since 1999, John Shaw has contributed majorly the transformation of Biocon from a small enzymes company to a globally recognized biopharmaceutical company. Over the past 22 years, John Shaw has played an important role in building Biocon, ensuring the highest levels of corporate governance in the company, as well as contributing to the strategic development of the group. On behalf of the Biocon's Board of Directors and management, we express our deep appreciation and gratitude to John Shaw for his stewardship and guidance. I would also like to share with you another organizational update. I'm pleased to welcome Dr. S. Vijay Kumar as Head of Operations at Biocon to lead the manufacturing projects and EHS functions for the generics business and will be part of the executive leadership team. Vijay Kumar is an industry veteran with more than 30 years of extensive experience across manufacturing and engineering in global diversified setups. Let me now turn to some business highlights. Starting with our generics business, we launched labetalol tablets and esomeprazole capsules in the US, further expanding our generics portfolio. Within Biocon Biologics, we expanded our biosimilars global footprint with product launches in 7 countries in Q1 this fiscal. We also received marketing authorization approval for biosimilar bevacizumab from TGA Australia, MHRA UK. The US FDA has scheduled a pre-approval inspection of our Malaysia facility in Q3 of calendar year 2021 in support of the BLA for our biosimilar Aspart. Syngene has signed a 5-year agreement with IAVI, a non-profit scientific research organization, for manufacturing 3 anti-HIV monoclonal antibodies for use in phase 1 and 2 clinical trials. I will now turn to financial highlights for the quarter. Let me start by saying that we delivered a revenue of 1,808 crores in Q1 this fiscal versus 1,712 crores last fiscal, a modest year-on-year growth of 6%. Our revenues were mainly driven by research services, which were up 41%, and biosimilars, which were up 10%. We reported a subdued performance in generics, which saw a degrowth of 22%. However, we largely sustained all our operational financial aspects of our business as we recorded a gross R&D spend of 136 crores for this quarter versus 142 crores last fiscal, and this corresponds to 12% of revenue ex Syngene. Of this, 120 crores is reported in the P&L while the balance has been capitalized. We also recorded a forex gain of 17 crores versus a loss of 4 crores last fiscal. Core margins, that is EBITDA margins, net of licensing, forex and R&D, stood at 30% in this quarter, and this is on account of subdued performance by generics that offset the gains of an improved performance in biosimilars and strong growth in research services. EBITDA for the quarter was 437 crores, largely flat year on year, and the EBITDA margin stood at 24% against 25% reported in the same quarter last year. PBT for the quarter was at 166 crores, down 9%, which is down, and this is at 9% compared to 15% of 249 crores in Q1 FY21, which is largely on account of higher depreciation and amortization and share of loss from our Boston-based associate startup Bicara. However, if you exclude the share of loss from Bicara, PBT stood at 224 crores. Novel biologics is the capital-intensive business, and while it impacts our P&L, it is an integral part of our business and future growth. We will explore external venture funding to support clinical development for long-term value creation. This is a high-risk, high-reward business, and we believe that these novel programs are important to pursue. Our net profit for the quarter stood at 84 crores versus 149 crores last fiscal. But if you exclude the share of loss of Bicara, our net profit was 142 crores for this quarter. And this largely basically points to a very sustained financial performance despite all the challenges we have faced because of the pandemic. I will now take you through the performance of our business segments during the quarter. Let me start with our generics business. Our generics revenues witnessed a degrowth this quarter, as I mentioned earlier, largely due to COVID-related headwinds that resulted in operational and supply chain challenges that impacted largely our API manufacturing. With the number of COVID-19 cases starting to decline, we expect these to normalize in the coming quarter. Additionally, the comparable period in the previous fiscal benefited from customers stockpiling APIs on account of COVID-related uncertainties. The segment delivered quarterly revenues of 486 crores. The quarter's PBT stood at 29 crores versus 96 crores in the same period last year. PBT margins also were at 6% compared to 15% in Q1 last fiscal. Tacrolimus capsules were launched in the US in Q3 FY20 and is witnessing a gradual ramp-up in demand. Our statin formulations portfolio in the US, comprising rosuvastatin, simvastatin and atorvastatin, held on to its market share despite continued pricing pressure. During the quarter, we launched labetalol tablets and esomeprazole capsules in the US in line with our aim to expand our formulations portfolio and establish a strong global presence. Labetalol is used to treat high blood pressure and helps to prevent cardiovascular complications such as heart attack and stroke, while esomeprazole, a protein pump inhibitor, is indicated for treatment of gastroesophageal reflux disease. Equivia pegs the market value for labetalol hydrochloride and esomeprazole magnesium in the US at 63 million and 230 million respectively. Travel restrictions in the wake of the pandemic continued to delay inspection of our facilities, and consequently launches as well as expansion into some key markets were affected. However, we are in discussion with the US FDA to see if we can apply the mutual recognition agreement announced in May 2021 between the US FDA, EMA and MHRA. We have responded to the complete response letter issued by the US FDA on Copaxone. We remain on track to commission our Greenfield API facility in Visakhapatnam in FY22. This will significantly expand our immunosuppressant manufacturing capacities, which will come on stream in FY23 post-qualification and validation. We are confident that our strong foundation in fermentation technology, coupled with several initiatives undertaken during the past year, including digitalization, cost improvement, and measures to boost operational efficiencies, will help us to significantly improve our business performance in the coming quarters. A note on novels. Equilium, our US partner, had an end of phase 1 meeting with the US FDA which confirmed a path to advance itolizumab into a single phase 3 pivotal study for acute GVHD to support their biologics license application or BLA. The study is expected to commence later this year. Biocon, who owns the European rights for itolizumab, would like to report an important milestone this quarter, wherein the Committee for Orphan Medicinal Products approved an orphan designation to itolizumab for the treatment of both acute and chronic GVHD. Meanwhile, itolizumab continues to be at the forefront of our fight against COVID-19 in India. We have ramped up our production capacity to meet the growing demand of the product. A second brand of itolizumab has been licensed to Sun Pharma for distribution. We have also completed patient dosing in the phase 4 study of itolizumab to treat cytokine release syndrome in moderate to severe ARDS patients due to COVID-19. The study report is expected to be converted into a publication in the near future. Let me move on to biosimilars. Biocon Biologics has recorded revenues of 758 crores in Q1FY22, a year-on-year growth of 10%, and also a sequential growth of 14%. Core EBITDA stood at 271 crores in Q1 FY22 versus 249 crores last fiscal, a year-on-year growth of 9% and 26% growth sequentially from 216 in Q4 FY21. Core EBITDA margins were at 36% in line with last fiscal, and profit before tax stood at 101 crores. We have seen a significant contribution from our COVID portfolio in India, predominantly itolizumab and remdesivir, in the strong growth delivered by our branded formulations India business. Thus far, more than 50,000 from these products. Our non-COVID products also have performed very well. Our biosimilars continues to maintain and garner market share in the US, whilst Fulphila, our biosimilar pegfilgrastim, maintained a steady market share of around 8.5%. Ogivri, our biosimilar trastuzumab, increased to over 9% volume share in June 2021. And our biosimilar insulin glargine is estimated to be around 2.6% about 20 basis points higher month on month. We anticipate continued pricing pressure in the US and are taking steps to mitigate this through increased volumes and market share. In addition to this, we expect our growth to be fueled by regulatory approvals for our biosimilar bevacizumab and biosimilar aspart in the near term once on-site inspections happen. In Europe, our sales continue to improve on the back of new market entries and better market share in key countries. The EU launch of biosimilar bevacizumab by Viatris is expected in Germany, Austria and Poland in Q2 FY22. Moving on to regulatory topics, the US FDA has scheduled a pre-approval inspection of our insulins manufacturing facility in Malaysia in Q3 calendar year 21 in support of our biosimilar aspart BLA. We believe the BLA is adequate in all scientific aspects, and it is only the pre-approval inspection of the Malaysia facility that is pending. However, with respect to our biosimilar bevacizumab BLA, we are yet to have visibility on the timing of the site inspection in India by the US FDA. We have received approval for our biosimilar bevacizumab from TGA Australia and MHRA UK. We expect the US FDA's decision on interchangeability of our biosimilar glargine by the end of this month. If approved, it will be the first interchangeable insulin approved in the US. We continue to make good progress on our robust R&D pipeline. To summarize on our biologics business, we remain confident on the long-term opportunity for biosimilars through improved market penetration, geographical expansion, and further growth from upcoming approvals. Coming to research services, during the quarter, Syngene reported revenues of 595 crores, up 41% over 422 crores in the comparable period last. PBT for the quarter was 95 crores with PBT margins at 16% in line with Q1 FY21. Syngene's performance was driven by growth across all divisions, discovery, development and dedicated centers. Remdesivir was also a significant contributor to revenues this quarter. The company's Mangalore API facility has also successfully completed ISO 9001:2015 certification audit. As mentioned earlier, Syngene has signed a 5-year agreement with IAVI for manufacturing 3 anti-HIV monoclonal antibodies for use in phase 1 and 2 clinical trials. Syngene will provide an integrated solution encompassing clone selection, analytical methods development, manufacturing process development scale-up, and cGMP manufacturing of drug substance, viral clearance studies, cGMP manufacturing of drug product, and stability studies. So you can see that Syngene now has end-to-end capabilities from cloned to market in every possible way. To conclude, I would like to say that this has been a challenging quarter for all of us. However, we are confident we can overcome these challenges with all the encouraging developments and opportunities that lie ahead. Business sentiment is favorable for biosimilars, generics, and research services. Globally, we see a strong demand for biosimilar and generic drugs, given the growing emphasis on affordable drug pricing. These are challenging times, and I would like to end by saying, let's be responsible. We all need to stay away from crowds. Let's double mask ourselves, maintain the proper COVID-appropriate behavior, and most of all, I hope every one of you has vaccinated yourself like we have at Biocon Group. Thank you. I would now like to open the floor to question and answers.
Thank you, ma'am. As we wait for the questions to queue, I would like to remind everyone that you can ask your question by selecting raise hand option under the reaction tab of your Zoom application. We will call out your name and you can unmute your line to ask the question. Our first question is from Prakash Agarwal from Axis Capital.
Yeah, hi. Am I audible?
Yes.
Yeah.
Yeah, hi. Thanks and good morning to all. My first question on, trying to understand this July end TAT date better. So, as per our understanding, what are the things pending, if at all, and what is our expectation of getting interchangeability, and how does it impact our assumptions for the market share ramp up, which we in the past have talked about that from calendar 22 only we will see some, since the buying is already happened or is the last commentary. So if you could give more color there, that would be very helpful.
I will turn this to Shreyas to respond.
Thanks, Prakash. We are, as Kiran said, we are looking for that interchangeability status. Our goal date is towards the end of this month, and we've reason to remain optimistic that our insulin glargine would be the first interchangeable biosimilar insulin analog that the FDA would approve. Now, having said that, we've talked about this in the past as well, that after the interchangeability status, Viatris would have to go through the full contracting cycle and secure the contract. So that piece will have to be completed in terms of securing the contracting piece. But it certainly does provide us the opportunity to then validate the decisions that payers have made in supporting the cost of biosimilars, rebuilding it into the formularies, and more importantly, also provide assurance to the patients, prescribers, and more importantly, when it can be made available at pharmacy counters in a substitutable manner. So clearly, there is a support to that overall strategy that Viatris outlined, where it has stated in the Investor Day that it is an opportunity now to relaunch Semglee as an interchangeable insulin glargine, the first of its kind. So we will certainly be looking at that uptake in the coming calendar year.
So on the contracting cycle that you spoke about, what is the contracting cycle currently? Is it ongoing, and would it help if we get the interchangeability, say, on the goal date, or it would actually help in the next contract?
The Viatris commercial team is right now in discussions with various payer channels at this point as we talk, and the interchangeability status towards the end of this month is in a way timely, because it will aid in these decisions as payers make them over the course of the next month or two.
Okay, got it. And secondly, on the inspections that you have talked about, both in Malaysia plant for asphalt, so everything done is what I understand, but it would require a physical inspection or it would be an online inspection? And I don't know what's the status in Malaysia, but has the FDA started visiting other countries and Malaysia? I am not sure. So if you could throw some light there. And in bevacizumab, is there a chance of online inspection? That's all from my side.
Yeah, thanks, Prakash. I think 2-3 questions in that, so let me respond. I think on the asphalt inspection for our facility in Malaysia, as Kiran said, the agency FDA has confirmed that they will visit us end of this quarter for a physical inspection on location. So that's something we were working with the agency closely for, and that's something the agency has consented to. So we will be looking to host the agency towards the end of this quarter, and the asphalt inspection should be then the only step to move us forward into the approval process. On the bevacizumab part, our goal date, as you know, was end of last calendar year, and we've been working with the agency to enable that inspection. The FDA did publish a resiliency roadmap where they are looking at international inspections in an expedited manner. We have been in engagement with them. We haven't received so far a firm date on when they will visit us in Bangalore. But at this stage, the understanding we have is there is no technical outstanding questions for the bevacizumab application. We've submitted a complete package, and we look forward to the pre-approval inspection, which is a mandatory requirement for a biosimilar approval in the US. So that's the update, Prakash, on bevacizumab and ASPA inspections.
Okay, sir. Thank you very much. I have a couple, but I'll join back. Thank you. Thank you so much.
Thank you, Prakash. The next question is from Damayanti Kerai from HSBC.
Yeah, hi. Good morning. I hope I'm audible.
Yes.
Okay. My first question is, can you explain what kind of P&L impact we should continue to see from Bicara? Maybe some more clarity, like what is spent from our side, and then what kind of impact we'll be seeing on the P&L, say in next few quarters.
Maybe Siddharth, you would like to answer this question.
Sure. So Damayanti, I think last quarter we had said that Bicara, which was earlier a subsidiary, would move to an associate because Bicara is looking at raising funds directly in the US to fund its clinical programs and the pipeline that is under preclinical stage. The investment value that we have for Bicara end of June is roughly $15 million. And we expect till this $15 million of expenses are there in Bicara, it will continue to go through the P&L, but through the share of loss of associate, which we expect within the next 1 to 2 quarters.
Okay, thank you for that. And my second question is, can you provide current split of biosimilar sales between regulated market and rest of the world market? And if you can talk a little bit more on what will be the key expectations for the rest of the market biosimilar sales, and what will be key drivers or key market which you are looking at that part of the business?
So let me request my colleague Sushil Umesh to talk about the biosimilars business in the rest of the world markets. Mute. Sushil, you're mute.
Thank you, Damayanti, for your question. In the rest of the world, we are looking at the biosimilar space very positively. We have a plan to quickly launch our new products and also increase our products in many more countries than where we are today. We do this with our partners and distributors, and we plan to have a very robust growth in excess of 25% over the years.
Okay, that's helpful. What is the current split between this regulated and rest of the world market sales for biosimilars?
Yes, you want to take it?
Could you please respond? I think you were already on.
Damayanti, hi. It's for the quarter, emerging markets is actually above 60%. But if you look on a full year basis, you'd see developed markets 40 to 45% and emerging markets around the 55% mark.
Okay, so just to clarify, 55% around rest of the world market and 45% for the regulated market. But as you
on a full year basis, but for the current quarter, emerging markets is about 50%.
Okay, thank you. I'll get back in the queue. Thank you for the opportunity.
Thank you, Damayanti. The next question is from Neha Manpuria from JP Morgan.
Thank you for taking my question. First on the biosimilar business, in ma'am's opening comments, she mentioned, there's a COVID portfolio contribution in the quarter. If there is a way to quantify that, just to understand how the base business will, look going forward. So just understand what's the COVID contribution in this quarter, please.
Well, this was specifically linked to the second wave. So actually, it is just sort of a blip in our BFI sales. So we don't expect it to continue at these levels. So it has contributed significantly to our branded formulation business in India, but we don't expect it to continue and contribute at these levels going forward. So that's as far as what I can So the branded formulations has certainly jumped, over 50% because of this contribution, but I don't think we can rely on this particular business beyond a few quarters.
Understood. And ma'am, in terms of, again for the biosimilars business, if I were to look at quarter on quarter, we have an FX gain. Please. So is it a reflection of our gross print or lower because of this COVID and because, ROW sales are higher. So what's driving the margin improvement should have been higher given the FX gain and flattish R&D spend.
So things. One is you must understand that always quarter one obviously reflects the increments that we give our employees, and that's a big impact on costs in the first quarter, which gets normalized for the rest of the year. Secondly, I think you must also understand that even though we have a contribution from the COVID products, the margins are at a lower level and compared to our other biosimilars business. And thirdly, I think I don't think you should read into the fact that ROW margins are low. So I think ROW is a very good business, and many markets have very rich margins. Of course, averages over the entire business. So I think overall, the margin impact has really happened because of the quarterly impact of salary increments, as well as some of the low margin sales that we have basically the quarter because of COVID.
Understood.
Just clarify, Neha, the FX gain. There's no FX gain in biosimilars, and when we talk about the core EBITDA margin at 36%, which is a 26% sequential growth. In growth terms is 26% sequential growth, and in margin terms is a 36% margin, consistent with last year.
Yeah. No, but I was looking at the absolute sales increase, year on year is pretty significant, right? So to that extent, the margin is flat, despite, R&D pretty much being in the 60 crore number. That's why I was asking. But yeah, ma'am's answer sort of, gives color on that.
Yeah, but it's
revenue growth 10%, EBITDA growth 10%, core EBITDA growth just about 10%, 9%. So they are all consistent. Yeah.
Understood. Siddharth, just on the generics business, given the supply chain and operational challenges, if that were not there, how much would you have expected? What was the impact because of that? I'm just trying to understand the normalized performance of the generics business.
So the impact on supplies because of the second wave was roughly 75 crores.
Okay.
We would have been very close to our fourth quarter. As Kiran alluded to, we have also seen continued pricing pressure in the US for our generics drug and also for our API customers. And unfortunately, we do not have any new approval because the couple of drugs which are under review with FDA, until the inspections are complete, we are not expecting any new launches. The two products which we launched were more in-licensing products. So these products were approved by our partners, which we in-licensed and launched recently. So we do expect some growth to come in. But the main point is that when we get additional approvals, the continued pricing pressure will continue to impact our generic formulations sales. But the API business, which was impacted in quarter one, we said that we have seen normalcy now. Number of cases in Bangalore have gone down. All our employees are vaccinated, and the operations are now running on normal course.
Understood. Thank you so much.
Thank you, Neha. The next question is from Surya Patra from Phillip Capital. Surya, you may unmute your line, please.
Good morning, everybody, and thanks for this opportunity. My first question would be on pegfilgrastim team. A couple of days back, we have seen a notification from US FDA to Amgen about the claims what they used to make about the product Onpro. And FDA has indicated that all the claims offer superior clinical benefit over the prefilled syringe that is baseless. So I think with those claims, Onpro was having initially about 60% market share of the total pegfilgrastim opportunity, and now they're still having over 50%. So with this notification, how should we look at as a kind of potential opportunity for Biocon?
Shreyas, would you like to?
Yes. Thanks, Kiran. So thanks, Surya, for the question. I think if you look at our previous commentary on the topic, we've always said that the Onpro device does offer an element of convenience, but we focused on making meaningful clinical difference through the prefilled syringes. That's been our focus, and this kind of, in a way, validates some of the positions we've taken in the past. And over the last 1 year, where we saw the effects of the pandemic resulting in the Onpro device holding on to a market share of around 58%. Over the last year, now we're starting to see that come off, and we're seeing that decrease to about 52% this year, or this quarter we just closed in June. So, in a way, it does create an opportunity for Fulphila, and we do see that in terms of how market shares in the last quarter have started to slowly ramp up with a 50 basis point increase in the monthly market share that we've seen in our product. And we view this as an opportunity to really make a difference in the market space.
Okay. So just I want to explain this question a bit more. The 340B program, what you had tied up with also for pegfilgrastim, and the kind of significant ramp up in the capacity for pegfilgrastim what you have already achieved prior to the COVID, and possibly the benefit of which all this would not have flown into you. So given that with the recovery in the business that and with a favorable notification from the FDA, all that considering, should one consider this as a kind of meaningful opportunity in the near term, or what time frame that you can see that, okay, there would be some meaningful progress in terms of penetration as well as contribution to the earnings?
Just to elaborate on that, Surya, I think the way it goes is these are certainly developments which bode well for an increase in market share going forward. But if you really look at it, the factors that will influence these things would be the competitor contracting strategies, the regulatory or the reimbursement strategies that exist in the marketplace. We certainly see this as a positive development and an opportunity for us. We have the capacity, the product, the approvals, and with increased customer focus or commercial attention to this, which Viatris has actually said in their previous calls as well, with a stronger value proposition that we can bring to stakeholders, we really see this as an opportunity in the coming fiscal to really realize a lot of this market share.
Thank you, sir. And about the interchangeability approval, so aren't we expecting the interchangeability approval for both the insulins, both aspart as well as glargine?
Yeah, so the aspart, as you know, we talked about insulin glargine a little while ago, where we are expecting it towards the end of July. We'll expect a decision on our application for interchangeability. The insulin aspart has been filed as an interchangeable insulin analog under the 351K pathway. So when approved, we will be looking at that approved as well as an interchangeable insulin analog.
Okay. Just last one question from my side. So on the Biocon If you can just help me understand, means what could be the early earning trigger for Bicara? Because we know that the first or the lead molecule is at the very early stage, in phase 1, phase 2 like that. And there is a upfronting of the spend also that we know that. So hence, if you can just give some sense on that side.
So Bicara has both the first program in the clinic at early stage of phase 1 development, and it also has a portfolio of molecules which are preclinical. So I think from that point of view, it is a growing startup. And as Siddharth mentioned, we have basically funded it, and they are on at the stage of looking for external venture funding. So I think that is where we need to support them, because the program is very exciting and some of the early signals are also very encouraging. So I think we would like to support them until they raise external finance.
And I think, let me just add, we expect some critical readouts on the first program which is in clinic by end of this calendar year.
Okay, the losses from the share of losses, whether that is restricted to, let's say, in current year and early part of next year or something, or it is a kind of a continued this thing till the time that we see some progression in terms of earnings.
So Surya, I think what I mentioned to an earlier question, that we have roughly $15 million left in our balance sheet out of the $40 million which we had funded, and that $15 million till it gets utilized will flow through the P&L unless we fund anything incremental over the next few quarters till Bicara gets this readout and does the external funding. So it is expected to be temporary. Definitely, we do not expect it to go beyond this fiscal year.
Sure. Thank you, sir. Wish you all the best.
Thank you, Surya. The next question is from Shyam Srinivasan from Goldman Sachs.
Hi, good morning, and thank you for taking my question. Just the first one on the COVID impact, going back to the earlier participant as well. I remember branded formulations India was some 100 crores, like the way we used to report earlier. Maybe I'm wrong. And if that has grown 50%, so 758 minus 150 is 600 crores. I'm making these numbers up, but looks like then the base biologics or the biosimilar business has declined QOQ. Would that be a fair way to think of things?
Chinni, you want to take this question?
Yes, the base biosimilar business is kind of flat versus last year if you strip out the COVID portfolio. But keep in mind that last year there was a spillover from Q4 into Q1, which boosted the Q1FY21 numbers. So if you strip that out, then you will still see a growth in the biosimilars business, excluding the COVID portfolio.
Yeah, Chinni, just so from a market share perspective, QOQ things have improved. So I'm just trying to understand where the struggle is for the business, right? And you talked about, I think, EM being higher and higher contribution and DM being lower versus how you envisage it to be for the full year. So what are some of the, translations? I remember in fiscal 21 call, we had actually said that the profit shares from VL can ease now, which will kind of help us accelerate this biosimilar business.
We're double counting there it's a COVID portfolio that's got the emerging markets shared above 60%. Just to clarify.
Sure.
And then the second point, of course, yes, as Glargine, as we start to increase our market shares in Glargine, you'll see the profit share from Glargine play out. And you're aware that we have 2 more approvals lined up for this year, plus a potential increase in market shares on our existing portfolio that's big, and trastuzumab should also play out and improve profit share in the coming quarters.
Got it. Very helpful. Second question is on the generics business. Siddharth, I think we have seen, kind of subdued performance. You talked about the 75 crore. And this now spans across multiple lines, right? So the 100 crore, I remember 4Q FY20, we couldn't ship things in the biosimilar line. 75 crore now on the generic line. So, from an operational and an ability to supply perspective, is the group looking at, what are some of these issues? Could these have been avoided? Can we do something in the path forward where these issues don't recur? Because just looking at peers, we have not seen this kind of like a QQ large volatility in numbers. Most of them have had it trended upwards. So I'm just curious from our own group perspective, where are the potential misses and how can we correct it in the path forward?
Very good question, Shyam. I think we do have a BCP and disaster recovery plans, but if you look at the second wave in Bangalore, we all know there were significantly higher number of cases compared to the first wave. Out of 3,500 employees in generics, in the second wave we had almost 500 employees who were positive within a span of 2 months, and that impacted a lot of the work schedule. The quality releases got impacted. Now that has been addressed by vaccinating all our employees. 100% of our employees in Hyderabad, Vizag, Bangalore are vaccinated. That's number one. Number two, again, Kiran had alluded, this is primarily a fermentation-based business, and for fermentation, these are large-scale fermenters. And one of the most important ingredient for fermentation to run is oxygen. And when there was overall high number of cases in the country, the allocation of oxygen was being done by central government, where a lot of the oxygen, even for the use, was diverted for medical use. And we were out of oxygen and hence not able to charge any new batches. Unfortunately, we treat this more as a force majeure where there is no mitigation plan. We were working with various state and central governments to see how soon we can get the required quantities that we needed, which did happen, as I mentioned, after 15 years. There was also certain other disruptions, but I think we do have overall a good plan in place. But an extreme situation like this wave 2, I'm not sure if at a very short notice we are able to address all the issues that come up. In fact, Q1 we didn't have any of these issues in the generics business. We had a very, very strong Q1 last year, and including H1, because number of cases in the company were still low. We were continuing to manufacture. We had supply chain issues which we addressed very efficiently. And so hope that these issues, at least on the employee front, do not happen if there is a wave 3 in the future.
Got it. Last question to the team is on R&D spend. So how should we look at it for fiscal 22 and 23? Is the current run rate now, or you see a step up happen in terms of R&D?
I think maybe I'll just give a view on the group level. We continue to maintain our earlier guidance of between 12 to 14% of gross R&D ex-Syngene revenues.
Got it. Thank you so much. Thanks and all the best.
Thank you, Shyam. The next question is from Harith Ahmed from Spark Capital.
Hi, good morning. I hope I'm audible.
Yes.
So on the generic business, my apologies if this question was addressed previously. On the generics business, after the disruptions we saw in the first quarter, how is the business shaping up now? And how should we think of the second quarter and the upcoming quarters?
So Harith, I'll split this answer into 3 parts. The operational impact.
Recording in progress.
Target action date, which was in calendar quarter 1. FDA moved to calendar quarter.
Recording in progress.
And at that entity, and
So the funding should be complete, or funding is actually dependent on the readouts. I mentioned that the readouts from the phase 1 clinical trial readouts are expected by end of this calendar year, basis which the funding timing would be decided. And the remaining 13% of the company is with the employees in ESOP pool.
All right. Thank you very much.
Thank you, Harit. The next question is from Nithya Balasubramanian from Bernstein. Nithya, please unmute your line.
Yeah, hi. I had just the one question on biosimilars in the US. So we know that CMS offers a pass-through status for the reimbursement rate that's given to 340B hospitals. And that's valid only for 3 years. So if you look at your fulfiller, you're possibly reaching that deadline in June. And that's likely to happen for some of your other biosimilars at a later point of time. So given that the delta between reimbursement is ASP plus 6% to ASP minus 22%, do you expect this to impact your margin profile meaningfully?
Yes.
Let me take that question. So, Nitya, yes, we are seeing that the CMS deadline come up shortly. We have developed, BFS has developed strategies to counter that pricing change, which will come up shortly. We believe the recent discussion that we just had on the call, also in terms of onshore, does provide us the opportunity to expand the market. There is going to be an increased competition in that space, also with more players than we started off with when these debates were fixed, and we will certainly have to have the right mix of whether it's just the pricing part or whether it's the reimbursement strategies that we talked about or the overall mix that we will be coming up with. But certainly BFS is aware of this, and we are looking at providing a stronger value proposition overall to the various stakeholders.
If I may just follow up, can you throw some color on whether, if you look at your revenue split between hospitals, clinics, and 340B, is it possible to provide some color on what's your exposure to 340B?
I think we'll have to do that often. Unless, Chini, you have that available with you. Do you have that split with you right now?
No, we don't have the exact split, but we have a lower share of the 340B segment. So our exposure is slightly lower there compared to some of the competitors, but we can't give you specifics on the numbers.
Got it. Thank you so much.
Thank you, Nithya. The next question is from Sameer Baisawala from Morgan Stanley.
Hi, good morning, everyone. The first question is on the pricing pressure that you're seeing in the US for biosims, Trastuzumab and Pegfil. Can you just help us what's driving this? You've been talking about this for the last 6 months at least.
So, pricing pressure in terms of the US, I can see the important piece is the biggest question around US was whether the US market will be accepting of biosimilars. I think that was the biggest question that we were faced with as we began the fiscal and maybe towards the end of last fiscal. I think that's been reasonably answered, that we've seen good adoption of biosimilars, and as competition increases, there is the natural fallout is that there is going to be some pressure on pricing. We've not seen pricing go down the generic route, so this is in line with the expectation when you see different major players enter this space. So we basically expect this to kind of stabilize. We've also seen more gradual decrease in prices overall, and the ASPs have been more in line with what you would expect in a market where you have 4 or 5 major players across the portfolio. So we're not really seeing anything out out of line that we had set out in the beginning.
No, sure, that's fine. But I'm just trying to understand what's the dynamics behind it, in the sense that if there is no new entrant over last, 6-month period, then what forces the price correction? Is one of the incumbent getting more aggressive, or is the payer demanding it? What's the catalyst behind the price cuts?
So pricing is one. Sorry. Go ahead. Sorry, can I respond?
Yeah.
So pricing is certainly one factor which plays a role in deciding this. But I think, as I was saying before, beyond pricing, there are other factors that play a role as well, in terms of how entrenched players are focused on therapy areas, in terms of what the competitor contracting strategies have been, in terms of what the overall payer dynamics are. So in addition to just the pricing, even the reimbursement strategies that have been put together play a role in terms of how market shares get allocated, and they're not equally weighted between the various various determinants on how these decisions are being taken. So pricing is certainly one factor, but not the sole determinant of market share allocations between the various players. And you will see that change over time across the various players. Certainly those who have been in the space in that particular therapy areas do create barriers given their long-standing relations with payers. And I think that's an area that Beatrice has also said in the past, that it has, there is an area for improvement that they've identified, and that's what they will be investing in.
Recording in progress.
Because bevacizumab itself has grown 5% market share in the US. So apart from 26% long-term play for in terms of bevacizumab to join it shortly.
With your permission, I just have one or two more, and that is, when did FDA confirm that it would come for the Malaysian inspection in 3Q? And I ask this question because I think Malaysia is through a very bad third wave. Just 2-3 days back, it's hitting almost its highest ever. Any reason to think that FDA can actually delay this? And second question, biosimilars entering phase 3 trials?
Okay. So let me answer the first one. The inspectors were visiting us on site and absolutely right, the third wave of Malaysia, despite lockdown, has been more aggressive, or on seeing are clear relaxations in different parts of the world, and those who are coming for visits for 15 days and less. And I think the way we work with the agency is they are confident of making the trip to inspect us and be with us. At this point, what we have to share with you is those plans are still on track this quarter. So that's on at our location. In terms of, we've said in the past that our products are progressing very well in terms of the CMC aspects of it. We are currently in the state where we are progressing them towards the clinic, and we will be updating you shortly once they get past that stage and are ready to.
Thank you very much.
Thank you, Sumit. The next question is from Charulata. Please unmute your line.
Recording in progress.
Would it be reasonable to market share in FY20?
Recording in progress.
The cost is an important element. Important lever to be successful in the market, but the first piece is the scientific aspect and
Recording in progress.
Looking forward to an interchangeable, or the first interchangeable insulin ever to have been approved by the FDA. So we're clearly looking for that decision. We are hopeful, and we're looking forward to that. So we're looking at the insulin portfolio, joining we're also looking at making
the risk, the cost, and the opportunity, which I think both.
Recording in progress.
So I think that's as much as I can say. I cannot really break it down into the share, but I would just say that it's a very equitable partnership.
Okay. Thank you.
Thanks, Tarang. We have another question from Sameer Baisiwala from Morgan Stanley. Sameer, please go ahead.
Thank you for the follow-up. Just a couple of questions. One is on the mutual recognition route with MHRA UK for Beva. What's the likelihood that FDA accepts this? And I guess, are there any case precedents where FDA has done so?
So, Sameer, I just want to correct you. The MHRA mutual recognition route has been actually pursued by the generics division. As far as the biosimilars or Biocon Biologics is concerned, they have looked at all avenues of trying to get our facility in Bangalore inspected, whether it's virtual, whether it's through mutual recognition. But we are yet to get a positive feedback from the agency. We at least appreciated that they gave us a positive feedback from Malaysia, but India is still not something that we have visibility on.
Okay, got it. Very clear.
If I may also add, in general, there has been not a precedence on this. I think this guideline came out in May. After that, I know that companies have reached out to FDA to get the advantage of this new guideline. And the FDA has reached out to us and requested for information which we have submitted, and we await that decision. So at least I have not heard again in the Indian generic context if any other Indian company has received an approval using this mutual recognition with MHRA or EMA.
Okay, great. And just on the interchangeability, I'm not so sure, maybe not a very right question, but would this be against the innovator brand, which is Lantus, or also against the other brand, which is Basaglar?